Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 23rd, 2026. How you doing? I hope you're doing well. I hope you had a good trading week last week. I hope you're having a nice weekend, and I really appreciate you coming to my weekend review podcast. I hope it is definitely going to be helpful for you. The format for the podcast today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades and the positions that I have and that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences of signals were, how I'm going to position size based upon my account value and the current market volatility when I entered the trade. I'm going to talk about how I set my emergency stop, how I set my end of bar stop, how I'm going to take partial profits each day if the market moves in my favor, how I'm going to get to trailing stop level and what that means and what I'm going to do from there, and then ultimately how I am going to exit the position if it gets to overbought levels. So we're going to talk about uh, when uh, when I entered, why I entered, and how I am going to manage the trades going forward. And hopefully this will be helpful for you to get an idea of how I look at trading, how I wait for setups, and how I manage the trades. After that, we're going to talk a little bit about trader psychology. It is the most important skill in trading, and the ability to create a plan and to follow it's extremely important. And so I always like to spend a few minutes talking about that. It's always helpful for me to teach, and I hope it is helpful for you to hear. And then last night I went down through my master watch list and I have identified some potential setups for next week. Now these trades are not where they need to be yet, but they are getting close. And really what I'm looking for is I'm looking for a combination of major support levels if I'm long below me. I'm looking for major moving averages, ideally that are inside of bullish order blocks. Potentially they're at levels where megaphone trend lines are getting to them. I'm looking at the RSI level. I'm looking at bullish MACD uh, divergences. And so I'm just kind of taking these all together. And so I will highlight what I'm looking for next week. Doesn't mean what I'm highlighting is going to actually get there and reject, but usually almost something always does. So anyway, hopefully that will be helpful for you. And if anything you find of value in the podcast today is good or helpful or of value, I really would appreciate if you could hit the thumbs up button. It really helps to keep the channel around, lets YouTube know that there's some valuable content so they can get it out to more traders, and hopefully it will be helpful for them as well. So if you could do that, I really would appreciate it. So let's go ahead and run this US legal disclaimer, get that out of the way, and then we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. So I had a really good week last week. Very grateful for that. Always grateful when I have good results for the week. And like I said, I hope you did too. But let's start off here with the first open position that I have, and it's Carnival Cruise Line. It's CCL. I did enter Carnival, got a very good entry on the 19th of May at 23.88. So you can see that has worked really, really well. So um, this particular entry is based upon a rejection of the bottom of this order block. This green box here is the order block. So it rejected it during the day. It went slightly under, but then closed back in. So that's a rejection of the bottom of this order block. So let's go back in the past and can explain to you why this is an order block. So in order to have an order block, we need four things to happen. The first thing that we need to happen is we need to have a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So you can see this qualifies. This bar is the low, and we have a higher low to the left and a higher low to the right. So number one, need a swing low. Number two, we then need the opposite. We need a swing high. A swing high is a high that has a lower high to the left and a lower high to the right. So now we've got two of four. Swing low, swing high. The third requirement is that we need to have another swing low. This is a swing low, higher low to the left, higher low to the right, that is lower than the first swing low. So we have three of four. Swing low, swing high, another swing low that's lower than the first swing low. And then when this happens, when we have that lower swing low in place, then we need to refer back to that first swing high. And then in the future, if the price can get over this over this swing high, now what we have done is we have changed order structure from bearish to bullish. And when that happens, now we can define the order block. An order block is simply the high and the low of the lowest closing bar prior to market structure change. So swing low, swing high, lower swing low. This bar here goes above the first swing high and therefore changes market structure to the upside. And on this day, we have defined the order block, the lowest closing bar prior to market structure change. And so as soon as this happens, when we take out that swing high, I know the high and the low of this bar is the order block area, or what I call it, the smart money area. And so now I bring this order block into the future. And in the future, if we come back down here is where I'll be looking to enter a trade. And I can do it multiple ways. I can get in with the rejection of the high of the order block. I can get in with the rejection of the low of the order block like I did on this trade. Perhaps there's a major moving average inside the order block that it rejects. That would be another way for me to enter. Possibly we get an under 30, over 30 RSI reading inside that order block. That would also be legitimate. Or as you've seen me do many times, sometimes I make my own levels in these order blocks based upon V1s, V2s from the past that are in the order block, or perhaps a large up bar in the order block, and I use the key levels from those from the V1s, V2s, and the large 180 up bar. So there's lots of different ways that I use order blocks. But I just want to kind of put something into perspective here. So we have the swing low, we have the swing high, we have the lower swing low. We break markets, or we change market structure to the upside. Very often when you break market structure to the upside, you will get some kind of pullback before the move up resumes, which is exactly what happened. You can see in this example, it rejected the top of the order block and then went much higher. But when you look up here at these levels, and then you look back down here to this order block, is it fair to say when you're up here at $30 and you look in the past and the order block is down here at $23, $24, that smart money was buying here? I would say 100% yes. When you're way up here and then you look back to where the order block was, I think it's fair to say in hindsight that, of course, smart money was buying here when it actually went all the way up here. So that's the idea. You identify the smart money area, you bring it into the future, and if the market then in the future comes back to that smart money area, that's the edge in the trade. Now, just because it was smart money once and really went up, it doesn't necessarily mean that it has to be smart money the second time or the third time, because things change with the economy, politics, all this kind of stuff. But so it's not for sure, obviously. But what I can tell you from over 30 years of trading is that when it comes back to the order block, it is smart money more often than it is not smart money. And that's the edge. And that's why I use order blocks so much in my trading. All right. So swing low, swing high, lower swing low, market structure change defines the order block, lowest closing bar prior to market structure change, bring it into the future. And now I am waiting for the price to come back down into that smart money area at some kind of level. And this is the trade right here on the 19th of May. Why? Because it rejected the bottom of the order block. So first things first, there's my trade. There's my entry. That's why I entered the trade. Now, the most important decision that you can make after you decide to enter, really the most important, is how many shares are you going to buy, right? And I use a formula. It's worked very well for me. It makes sense. There's a lot of common sense to this formula. And it has two inputs. The first input is how much is in my trading account? Pretty simple. You should know that, right? Let's just say I have $100,000 in my trading account. I simply take 1% of the 100,000, which is $1,000. That's going to be my maximum allowed loss on this trade. If you have $500,000, 1% is going to be 5,000. If you have $1 million, it's going to be 10,000 will be your maximum allowed loss. If you have 50,000, it's going to be 500. So it works for with whatever. So let's just say in this example that I have $100,000, 1% is $1,000. This is going to be my maximum allowed loss on this trade. Then I take whatever my maximum allowed loss is, and then I look for the value of the 2ATR. 2ATR, essentially what it does, it's measuring volatility. If volatility is higher, this number is going to be larger. If volatility is lower, it's going to be lower. So what I do, 1% of my account, 1% of 100,000 is 1%, and I divide it by whatever the value is of the on the day that I enter the trade, divided by 2.33. Based upon this formula, it's telling me to buy 429 shares. If volatility was much higher, this number would be larger and it would have me buy fewer shares. If this number was lower, it would have me buy more shares. So I think it's very important that you position size based upon what the volatility of the market is doing. If the market's super, super volatile, just makes sense that you should trade smaller, and this formula will just automatically do it for you. All right. So rejected the bottom of the order block. That's my entry. I position size. I know I'm buying 429 shares. Now, when I did the calculations on how much I'm going to lose, my maximum allowed loss here is $1,000, right? So I have to put my emergency stop. And my emergency stop is very simple. It's just my entry price minus the 2 ATR that we just did the math on. So if I take my entry price minus 233, I put my red line down here. This is my emergency stop. Or in other words, if I have 429 shares and it moves $2.33, how much have I lost? $1,000 because we just did the math, right? So, at some point on a trade, you have to decide I am wrong. This is as much as I'm willing to give up. Doesn't matter what I think of the stock, or maybe if I think it's going higher. It doesn't matter. You've lost what you said was the acceptable amount of loss for you, and you've got to get out. That's it. But the good news there is that this emergency stop where you lose 1% of your account doesn't happen very often. It only happens 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because I hit my emergency stop, the 1%. It's going to be because the price stopped under my end of bar stop. So I always have two stops, an emergency stop and an end of bar stop. Well, on this particular trade, I took it because it rejected the bottom of the order block. Therefore, my end of bar stop would be if it just simply closed below the low of the order block. Even if it closed 2 or 3 pennies below, I've lost the order block. That's my signal to get out of the trade. And I didn't lose anywhere near 1%, right? So 5% of the time, I'm going to hit my emergency stop, 1%. The other 95% of the time, if I have a loss, it's going to be smaller than 1%. And it's important in trading that you have a good risk to reward ratio, meaning If you're wrong, you can be wrong small, and if you're right, you have the potential to be right big. That's just the key component of trading. And this is a very good risk to reward ratio. Look, my entry is very close to where my stop is to begin with, and that's the key. And so I also want to say all of my entry decisions and exit and entry decisions are based upon the closing price of the bar. Okay. At the end of the day, the large financial institutions come into the market, they move the market. They have very smart people, they're dealing with the most money, they have the best information, they have the best technology. And so the closing price of the day, in my opinion, is the most valid price of the day to make my buying and selling decision. So I wait until the end of the day to see whether or not I need to get out, get in, stay in, right? And so just want to make sure. However, with the emergency stop, that is not based upon end of bar stop. If I ever hit it, regardless of what time of the day, I have to get out, because if I hit that emergency stop, I have lost that 1% of my account, and I just can't lose more than that on any one trade. Okay, so rejection of the bottom of the order block, I position size, I place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. Now, the next thing I do when I have all that taken care of is that I look to the value of the 1.5 ATR, and the value of the 1.5 ATR on right this moment is $1.75. So now I take my entry price and I add whatever the value is on the day of my entry to my entry price. So I take my entry price plus, if I did it today, it would be $1.75, and I place this orange line above. This is my trailing stop level. So if in the future the price goes up 1.5 ATRs from my entry, now I am in trailing stop mode. And all that trailing stop mode means is that once I get to that trailing stop mode, I don't do anything on that particular day. It just means now I have reached a particular threshold that if in the future I have a close below a previous bar's low, I'm going to exit half of my trading. In trading, if you enter a trade and it moves your preferred direction, at some point you want to tighten up your stops, because you don't want to give it all back. If you're lucky enough to have it move nicely in your direction, you don't want to just give it all back. And so going into trailing stop mode is the method that I use to tighten up my stops. So if I get to trailing stop mode, then in the future, if I have a close below previous bar's low, I'm going to exit half. That has the effect of moving all my stops up by half. I mean, I'm sure you've heard in trading, once it starts moving your way, you got to tighten up your stops. That's exactly what I do. I don't move the stops up necessarily, the emergency stop or the end of bar stop. What I do is I sell half the position, and that has the same effect of moving everything up. All right. So, and that's why I placed the orange trade there. I took my entry price plus the value of the 1.5 on that day. That's where my trailing stop level is. And so if it gets there, now I'm in trailing stop mode. In this trade right this moment, I am in trailing stop mode. So everything I've talked about so far as placing your emergency stop, your end of bar stop, going into trailing stop mode, these are all defensive moves. In other words, if the market does something not in my favor, I have to take action. I have to act defensively. But just like any sports team, it's important to have good defense, but you have to also play offense. And the way that I play offense is I take partial profits each day if the price moves a certain amount from the previous bar's close. So let me show you exactly. I haven't done this on my charts for myself, for my trading, for Tuesday, excuse me. So let me just show you how I do it. So I'm in CCL at the moment. All that I do is I take a look at the closing price. The closing price is 25.98. Okay, so I just take the closing price. Now I refer back to where the value is of the 0.45 ATR. At the moment, it's 53 cents. Now this moves every day. Okay, it's going to change every day. But at the moment, for the next trading day, Tuesday, I just use this amount. So I take my closing price, 25.98 plus 53 cents. That equals 26.51. So my first profit target for Tuesday is 26.51. So let's just mark this up. Boom. There's my first profit target for Monday. And the question is, well, how much are you going to take off there? And the answer is very simple. However many shares I go into the next day with, I take 10% off. So if I have 50 shares at the moment, my first profit target, I'm going to take 10% of that off. I'm going to take 5% off at that first profit target. But I don't just take one profit target. I put 3 profit targets each day. So the first profit target that I just did here, closing price plus the value of the 0.45 ATR is 26.51. Mark that there. How do I get my second? All I do is take my first, 26.51, again add to it the 0.45, which is 53 cents. 27.04 is my second profit target. And again, I would put a limit order in my system to take off 10% of however many shares I went into the day with. If I went into the day with 50 shares, I put an order to take 5 off here at the first profit target. 26.51. I put another limit order to take off another 5 shares at 27.04, and I do it one more time. I take the second profit, 27.04 plus 53 cents. Third profit target for Tuesday, 27.57. And of course, these are all going to be equidistant. And there you go. So if I go into Tuesday with 50 shares, I put a limit order in my system, say, please sell 5 shares, 10% of however many I have, 26.51. Please sell 5 shares at 27.04, and please sell 5 shares at 27.57. Now, if it goes down the next day, I don't hit any profit targets, right? And then I would just have to, if I'm still in the trade, I have to recalculate it based upon the new closing price. If I have a decent little up day, maybe I take off 1, which is great. I lock in some profits. The market can't take it away from me. I reduce my position size. And honestly, I think there's a lot of advantages of every day reducing your position size, because the more you reduce your position size, the more likely you are to keep following your process. It just takes the stress off. So that's an added benefit. All right. So, okay. So I've kind of given you the basics of this trade and kind of the important levels and the stops and so forth. And I know I've taken a long time to do that, but I just wanted to get a good foundation. So now that we've kind of covered all this, let's just go through the trade. Okay, again, and on the other positions, I'll go through these much quicker. So on the 19th of May, I entered CCL. Why? Rejection of the bottom of the order block. I entered at 23.88. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the green box, or in other words, the close below the low of the order block or the smart money area. I placed my trailing stop level 1.5 ATRs above my entry, and here we go. The next day opened a little higher, went down. I was like, shoot, it's not holding, but it was temporary. I wait until the end of the day to make my buying and selling decisions, and had a monster day up. You can see I ripped through all the profit targets and more. I think I placed a fourth profit target in there as well. And on the very next day, we got to trailing stop level. Again, doesn't mean I do anything. It just means now I'm in trailing stop mode. The next day, opened lower, closed a little higher. And then on Friday, we closed slightly lower. So a really good trade starting off in 3 days. The remaining shares that I have on CCL are up 8.08% in 3 days, which is a fantastic trade. So you can see the smart money in the market did react to this level down here. So yeah, great trade right off the bat. Whenever you have a trade and it starts moving your way immediately, you kind of look and went, okay, I think I did a pretty good job of analyzing that. So again, really good risk to reward ratio. And having a good risk to reward ratio doesn't mean you're going to have a positive trade. The very next day certainly could have just closed below. But the point is, I set it up to where if I was wrong, I would probably be wrong small. And I had the opportunity, I have the potential for a big trade, which it was. And really, that's what trading comes down to. So the remaining shares up 8.08% on the CCL trade. All right, UNG. So UNG, a little different setup than what I just explained to you. All of the majority of the strategies that I trade, I manage those trades exactly how I just showed you, with emergency stops, end of bar stops, taking partial profits. There is one strategy, however, where I manage it differently, and this UNG trade is one of those examples. So I did enter UNG. Oh, excuse me. I've been in this trade for a minute, so I did enter UNG here on the 15th of April at 10:57. So why did I enter here? Well, it has to do with something that happened in the past. And you can see this trade's been up, it's been down. It was way up last week, and then we came down pretty strong, but still positive. But why did I enter on the 15th of April at 10:57? Let's go back in the past and I'll show you. So it has to do with these three bars here that I have highlighted in green. These bars are called a island reversal. And island reversal happens when you have an initial gap down. You can see here on the 13th, we gapped down. And then we kind of went sideways for a few days, and then we had a big gap up. So it left these three bars here kind of by themselves, kind of like an island chain by themselves. Gap down, there was sideways motion, and then immediate gap up. This is bullish. This is called the bullish island reversal. And you can see once that happened, for the next couple weeks at least, it really was super bullish. But the key is that when you have an island reversal, the high of this island reversal, the highest bar here, if you come back in the future to that, this has inherent support. And so I like to key off of this level. So the high here of this bar was 1057. It's essentially where I bought it. So I noticed this happening. I said, I just, filed it away and said, in the future, if we come back and reject this level, then I would be interested in getting long. And so when we go to the day that I entered, this is what happened. On this day, we did reject that 1057 level, the high of the bullish abandoned baby. So I entered here at 1057. Now, when I use an abandoned baby or an island reversal, they're very similar. I manage them differently. I simply put my emergency stop 2 ATRs below. If it gets there, I lose 1%. But to the upside, I place a 4 ATR profit target, and I let the trade go. I mean, in the future, for sure, eventually, I'm either going to lose 1% of the 1% on my account on this trade, or if I'm right, I'm going to make 2%. So I have an asymmetrical risk to reward ratio. If I'm wrong, I'm going to lose 1%. If I'm right, I'm going to make 2%, right? Now, I didn't do this at a random area. I started this trade because it rejected a key level. And in my experience, I am more likely to make 2% than I am to lose 1%. So I'm more likely to make double my money than lose one time my money. And that's the idea of the trade. So I enter here, 2 ATR stop, 4 ATR profit target, and that's it. I just let it go. You can see last week I got very close to hitting that profit target. Didn't quite get there. We had a pullback. But all in all, still this particular trade, although it's not finished, up 3.29%. So pretty good, and I'll just let it go until it hits my 2 ATR stop or my 4 ATR profit target. But the current position as it is, up 3.29%. Okay, CSGP. CSGP, one of my favorite setups, is called a higher low V1 or V2. And so I did take the trade here on the 20th of May at $34 even. And so let me explain to you what a high or low V1 or V2 is. First of all, let me bring your attention to these two green lines. This green line is called the -1 ATR channel or Keltner channel. The top green line is the 1 ATR channel or +1 Keltner channel. So just the one Keltner channel and the -1 Keltner channel. Anywhere above the minus Keltner channel and below the 1 Keltner channel, so essentially anywhere inside this area between the green lines, is called the value zone. There's always a time when a particular stock is in value. If you're below the bottom Keltner channel, you're below value. If you're above the top Keltner channel, you are above value. Well, this is called a high or low V1 in the value zone. So first of all, this trade has to occur in the value zone. In general, I like to buy below value and at least sell in value, or I like to buy in value and sell above value. But what I don't ever do is buy above value. Most retail traders like to buy above value. Most professional traders, at the very least, like to buy in value or below value. So this particular trade has to happen in the value zone. So the first requirement for this higher low V1 or V2 is that, first of all, we at some point need to have closed below the bottom 1 Keltner channel. And clearly we did that. The second requirement is that we then have to go back up into the value zone, which of course did happen. We got above that green line. The third requirement is that we have to have a pullback and a reversal back up, having a V1 or a V2. V1s and V2s are very helpful. They're really good entry signals. If you want to learn more about those, you can go to my YouTube channel and just look up V1s, V2s. But this particular entry here is called a V1, and a V1 consists of two bars, bar 1 and bar 2. And the rule is bar 2 has to go below bar 1's low, which it does, and then it has to close above bar 1's close, which it does. Okay, so bar 2 has to go below the low and then close above the close. If that happens, that is a V1. Now, so that's why I entered the trade. We closed below the value zone, we came into the value zone, we pulled back, created a V1 or a V2. In this case, it's a V1, and it's called a higher low V1 because this low is higher than this low. So that's why they call it a higher low V1 or V2 that closes in the value zone. So that's why I entered the trade, got in at $34 even. Now, I position size like I always do correctly, so that if I'm wrong, I have a maximum loss of 1% of my account. I place my emergency stop 2 ATRs below. Now on a V1 or a V2, your end of bar stop is simply a close below halfway of the number 2 bar. Take the high and the low of the number 2 bar. Halfway of that should be the support on the trade. So my end of bar stop is if we close below halfway, and you can see that's why I drew the halfway mark into the future. So I enter the trade, place my emergency stop 2 ATRs below my end of bar stops, close below halfway of here. I put my trailing stop level up here, right? So if it gets there, I go into trailing stop mode. Has not gotten there yet. The next day, during the day, you can see we did test underneath halfway of this bar. We didn't find any more sellers there. That's why CSGP reversed back up, closed above, kept me in the trade. And then again on Friday, went up a little bit and reversed back down. So this trade is at the moment, this trade is very close to being even, actually down just a little bit. I'm down 5 cents on the trade, so down 0.09%. But going forward, as long as we stay above, close above 33.26, it will keep me in the trade. If it starts to move up, I will take partial profits each day, the partial 0.45 ATR profits. If it moves up and gets to trailing stop level, that's perfect. Then I go into trailing stop mode. And if it closes below 33.26, halfway of the washout bar, I simply get out of the trade. So, I structured this trade so that if I know my maximum, my worst case scenario, I know that if I'm wrong, my end of bar stop is pretty close to my entry, so it's a good risk to reward ratio. And hey, If things work out, it can go way up, but that's trading. Creating a structure of a trade so that if you're wrong, you can be wrong small here and know the worst case scenario, be wrong small, but have the potential for a big upsize gain. And that's what I've done. So this trade here, down 0.09%. Dash has been a good trade. I entered here on the 14th of May at 153.70. You can see there's a green box here. That is an order block. Now, a little while ago, I mentioned sometimes I will create my own levels inside the order blocks. These don't have any moving averages in here. So let's go back and take a look at, so my key level here was 151.40. So let's go back in the past and find out why I use this level. Well, here's the order block: swing low, swing high, lower swing low, market structure change, defines the order block, lowest closing bar prior to market structure change. But here is a V2. We just talked about a V1. Here's a V2. A V2 consists of 3 bars: bar 1, bar 2, bar 3. Bar 1 has to go below bar 1. Bar 2 has to go below bar 1's low, and then bar 3 has to close above bar 1's close. There's your V2 entry signal. Yep, pretty good. But remember, the stop on a V1 or a V2 is halfway of bar number 2, or the washout bar. So I drew the line here at 151.40 because it's halfway of the high and the low of this second bar in the V2, and that's my key level. I know there's some inherent support here, so that's why I brought it into the future, and that's why I entered the trade. The previous day we closed below that key level. The next day we closed above, so it rejected that key level. So I entered here 153.70. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this key level, 151.40. So I entered 153.70. I placed my trailing stop 1.5 ATRs above, and here we go. Next day goes up, nice, profit target. Next day goes up, nice, profit target. Next day down, closed below previous bar's low, but I didn't do anything because we didn't quite get to trailing stop level yet. Next day, everything went crazy. At one point, not only was I under my key level of 151.40, but we lost the bottom of the order block, but that was only temporary. By the end of the day, it closed higher. That's why I wait until the end of the day. So that kept me in the trade, plus a profit target. Next day didn't really do much. Next day, which was Friday, 2 things happened. I hit a profit target near the high, and I also hit my trailing stop level. So now I'm in trailing stop mode. All this means is now it's in the future, because I'm in trailing stop mode. If I have a close below previous bar's low, I'm going to exit half. So Tuesday, if we close below Friday's low, I'm going to take half of however many shares I have left. The amount of shares I have left is less than what I began with because I took profits along the way when the market provided them to me. Okay, so anyway, been a fine trade, been pretty good, really. So the remaining shares that I have here on DoorDash up 4.16%. GDX. Okay, GDX is a trade that I just recently took. I took this on Thursday here at 86.10. Why did I take it? Well, 2 things happened. We had an intraday rejection of the 200-day moving average, which is a primary signal. We also rejected the bottom of the order block, meaning we were below the order block and we closed back above it. So 2 primary signals for this trade. So I entered here 86.10. I position size. I placed my emergency stop 2 ATRs below. Now, if you remember, if we get down there and I touch that, I got to get out. I've lost 1% of my account, but also remember that only happens infrequently, about 5% of the time. My end of bar stop on this particular trade is simply a close below the 200-day moving average, the black line. And you can see I barely stayed in the trade on Friday because the 200-day moving average is 84.91. We closed 85.05, so yes, it did close above the 200, so it kept me in the trade. Friday had this close below the 200-day moving average, or in other words, if it had closed below 84.91, I simply would have had to have gotten out of the trade for a small loss, right? It's fine. I can always get back in, but it did keep me in the trade, so I am still in the trade. Now, currently I am down on the trade. Let's get a number here. 1.16% on the trade. But Friday, Tuesday, if we close below 200, I'm out. It just didn't work. If it holds, keeps going up, great. I'll continue to take profit targets, maybe get to trailing stop mode. It's fine. So everything depends on this black line. If it closes above this black line, I'm in, I'm bullish. If it closes below that black line, I'm out, I'm bearish. I can always get back in. All right. So this particular trade at the moment down 1.16%. Silver. Okay, just like UNG, this is one of those trades that I manage a little bit differently. And this particular trade is using let's go back in the past here. This was kind of a hybrid. This blue bar, or this blue outline on this bar here that I've highlighted, is an abandoned baby. I showed you what an island reversal was. Island reversal is when you have gap down and you have more than one bar moving sideways and then a gap up. Okay, an abandoned baby is exactly the same thing. It's just that it uses one bar. You can see blue bar, the highlighted blue bar. The previous bar we gap down, but then the very next day we gap up. When this happens, this is bullish. When you have a very quick and sudden change from bearish sentiment to bullish sentiment, more times than not in the future, that price is going to be higher. So that's one of the reasons why I entered here at 69.80, because we had the bullish abandoned baby. The other signal of why I took the trade was, you can see the bar the day before I got into the trade, we were in the order block. Okay, the order block's a key level anyway. We closed in it, and then the very next day we closed above it. So it was a rejection of the order block and an abandoned baby. Okay, so I decided when I took this trade that I was going to do a either or trade. I placed a 2 ATR stop below. If I get there, I lose 1%. I place a 4 ATR profit target above. If I get there, I make 2%. Okay, so I'm risking 1% to make 2%, but I'm more likely to hit the 2%, so it's a pretty good setup, and that's a pretty good proposition. So you can see I entered here. It moved up nicely to begin with. It's literally been kind of all over the place since I entered. Give you a little better perspective here. So we entered here, went my way right away, then went all the way down, but didn't get to my emergency stop. Then we had another move up, then we had another move down, then we had another move up. Oops. And we went straight up, and now we're straight down. So this particular trade at the moment is down. And it's down 2.09%. But I'm just going to stay in this trade until one of two things happen, right? Until I hit my 2 ATR stop or hit my 4 ATR profit target. It could be a while, could be months, right? So we'll see. But this particular trade at the moment down 2.09%. LMT, been a great trade. LMT is Lockheed Martin. I did buy Lockheed Martin here on the 11th of May at $512.08. Why? Well, in this particular case, you can see it has to do with an order block, and it has to do with the rejection of this 250-day moving average. This is the purple line. So two primary signals. We had a close over the 200 inside the order block. That's a primary signal, and it happened inside the order block. So two primary signals, plus we had a V1 as well. That's a secondary signal. So I entered here 512.08. I positioned size correctly. I placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below this purple line, a close below the 250. You can see I entered just barely above it. So I created a good risk to reward ratio for myself. Placed my 1.5 ATR trailing stop level above. Next day, took off, hit a profit target. That's good. Next day, down a little bit, but holding above the 250. Sideways motion, sideways motion. Had a big up day here, which was nice because I hit a profit target into that strength. Then a couple more days of sideways motion. And then on Friday, we had a nice day up. I did hit 2 profit targets, and you can see I got to trailing stop level. So now I'm in trailing stop level on this trade. All this means is in the future now, if I have a close below previous bar's low, I'm going to exit half of the remaining shares that I have. So this particular trade doing pretty well, currently up 4% from entry. All right, and the last open trade we have is RBLX. Been a really nice trade. Yeah, okay. So really the entry point for this particular trade was one day before I bought it. And why is that? Because the previous day we closed under the 30 RSI, and then the next day we closed above 30 RSI. So not only did we reject the high of the order block and we have a close above the 30 RSI, we rejected the negative third ATR channel, which is also a secondary signal. But on this particular day, I found another trade that I liked better. Okay, I could have taken this trade, completely legitimate, but I had another trade that I liked better, and so I passed. The next day, I did enter the trade. Now, the next day it was down, but the thing is, had I taken it the previous day, I would have still been in the trade on this day. So is it okay for me if I didn't enter the previous day to enter the current day at a lower price? And the answer, in my opinion, is yes. If I was in the trade the previous day, I'd still be in it. So the way that I look at it is that it's okay to get in if the trade is still valid if I'm getting a better price. And that's exactly what happened. So excuse me, I entered here 42.85. My end bar stop was simply a close below the 30 RSI. I placed my 1.5 ATR trailing stop level above. Next day, took off like a rocket ship. Hit multiple profit targets. Fantastic. Next day was down, no profit targets. Next day up was profit target. Next day up, no profit target. And then here on Friday, I hit a profit target as well. And you can see I also got to trailing stop mode. So now I'm in trailing stop mode. It doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half the remaining shares. This particular trade up 11.12% in 1, 2, 3, 4, 5 days. Great trade. I was very patient, waited for this trade, waited for the signals, had a good entry price with a good risk to reward ratio, and it paid off. So up 11.12%. So the current positions, just to do a recap, CCL doing well, up 8.08%, UNG remaining shares up 3.29%, CSGP remaining shares down 0.09%, Dash remaining shares up 4.16%, GDX remaining shares down 1.16%, Silver remaining shares down 2.09%, LMT remaining shares up 4%, and RBLX remaining shares up 11.12%. So again, in trading, you're going to have losses, you're going to have gains. The acceptable numbers are, yes, big gains are acceptable, obviously. Small gains are acceptable. Break-even trades are acceptable. Small losses are acceptable. What you have to stay away from, everybody, are the large losses. So you can see the current open positions that I have are not all profitable, but the common denominator is there are some that have big gains, double-digit gains. I have some that have small gains. I've had some of my current positions have small losses, but you haven't seen any large gains. And that's really the calculus in trading. That's really what you have to have. And it all depends about how you structure the trade and get into the trade. All right. So now those are the current open trades. Let's take a look at the trades that I closed last week. All right. So this is Exxon. I did enter Exxon here on the 8th of May at 144.41. Really nice trade. Really good setup. Happened in an order block as it usually does. I rejected the 100-day moving average in the order block. Okay. I entered at 144.41. I position size, I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this red line. That's it. And the entry was very close to that red line to begin with. I placed my 1.5 ATR trailing stop level above. Next day, boom, takes off like a rocket ship. Good start to the trade. Hit some profit targets right off of the bat. Next day went up a little bit. Next day up a little bit. Next day up and got to trailing stop level, which is perfect. Don't do anything. It just, now I'm in trailing stop mode. Next day, big monster day up. A lot of profit targets. Next day, big monster day up. More profit targets. Next day, up again, profit targets. And then here, I exited the trade at 157.20. Why? Well, up here when we started to get elevated, we got to a 65 RSI level. And if I ever get to a 65 RSI level, then in the future, if we close below the 5 EMA, that's my exit to get out of the trade. And that is why I did exit. And so the remaining shares, I locked in a gain of 8.15% on the trade. And again, because we got to a 65 RSI level and then we closed below the 5, closing below the 5 after you've had a big trending up move for me is my signal. And so locked in a gain of 8.15%. So really, really nice trade there. And of course, I did lock in some prices higher because of taking the partial profits. Okay. This is a frustrating part of trading when you're right, but maybe you're off by 1 or 2 days. So some good examples here on these exits. So Southwest Airlines. I did get into Southwest Airlines on the 30th of April at $37.99. Why? We had to close over the 200 primary signal, and then we had to close in and then close above the top of the order block, also a primary signal. So that is why I entered $37.99. I position sized, I placed my emergency stop 2 ATRs below. I placed my end of bar stop just to close below the 200-day moving average. I placed my 1.5 ATR trailing stop level above. Next day, boom, takes off like a rocket ship, hit multiple profit targets. Then we had a pullback. Next day up, profit targets. Next day up, big profit targets and got to trailing stop level. Then we had a couple days sideways. Now here on the 11th was our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the remaining shares and I locked in a gain of 5.38%. We continued kind of down sideways and then down. And then here on the 19th, we finally did close below the 200-day moving average. That was my stop. I had to sell the remaining shares for a loss of 1.71%. But this is a good example, everyone, of why I like to take partial profits when I have them, and then how important using this trailing stop mode is, because I got out of half of the shares here. So the shares that I sold on the way up and the half position that I got out of here certainly mitigated the loss when I got out. So I did the remaining shares, I had to take a loss of 1.71%. And then this is the frustrating part of trading. I got out, next day takes off like a rocket ship. I can't get back in here. The risk to reward is not good, and it just continued to go up. So this happens in trading. It's just one of those things. But actually, all in all, this trade was positive. Here it shows a loss on the remaining shares of 1.78, but really it was positive because of taking the partial profits and trailing stop move. But just for the record books, just for the stats, the remaining shares was down 1.71%. TLT, I had the right idea. I missed it by a day. I did enter TLT here on the 18th. We went under 30, over 30. This is a deep dip buy signal. By the way, anything involving a 200, 250, 300 moving average or an under 30, over 30 is considered a deep dip buy signal. And so I did have a deep buy signal on this day because we went under 30, over 30 during the day. That's a deep dip buy signal. Happened in the order block, so that makes sense to me. So I enter here 83.57. I had my emergency stop 2 ATRs below my end of bar stop. is simply if we close below the 30 RSI, and that's what happened the next day, I had to get out of the trade for a loss of 0.67%. I got out, and then look, immediately right back up. I didn't get back in. I didn't like the risk to reward ratio. So that's just one of the things of trading. You know, when you trade with these rules and you get out and then the next day it rips higher, you're like, dang it. But listen, a lot of the time when this were to happen, very likely it could have continued down and I would have been very happy that I took my loss. I see that a lot more times than I get out and it just roars back up, although that did happen a couple times this week. So anyway, 0.67% loss, small loss, not a big loss. So acceptable in the terms of the outcomes I can get from wins and losses from the trade, but a little frustrating because I did have the right idea. I just was one day off. All right, VIX. All right. VIX is a wily coyote. So I did get into VIX here on the 1st of May at 28.80. We rejected the top of this order block. Whenever we got back down to this bullish order block on VIX, it had bounced in most recent occasions. This time it did not. So I entered here at 28.80. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of this order block. I placed my 1.5 ATR trailing stop level above. Next day took off. Thankfully, I hit a profit target up there and reduced my position size, right? Then we just kind of drifted down lower, hit another profit target here, thankfully, for a little bit of a profit, but more importantly, reduced the position size. And then we just head down. I had to exit the trade here on the 18th of May because we closed below the low of the order block. And I had to lock in a loss of 3.68. But luckily I did because look, we are much lower from there. So this was a loss of 3.68%. This was my biggest loss on any trade I had this week. So recap on the closing trades, Exxon up 8.15%. Love had a loss of 1.71%. TLT had a loss of 0.87%. And VIX had the loss of 3.68%. So what you're going to see, my open positions almost always are going to be profitable. My closed positions, more likely than not, will be negative because that's why I closed. All right, so those are all the daily open and close trade. I did have one trade on the weekly that I'll share with you. I also like to trade on the weekly bars. And so far, this has been a good trade. I exited last 2 Fridays ago at 276.39 on the weekly bars. Why? Because on this particular day, we rejected the 200-week moving average that was inside an order block. So I entered 276.39. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200. Place my 1.5 ATR trailing stop level above. And so far, it has gone up. You know, it's interesting that this has gone down month after month after month, but then finally, when we got a legitimate signal, it started to go up. To me, that shows that professional traders saw that signal and are coming in. And currently, this particular trade on the weekly is up 2.05%. So there you go, everybody. Those are the current open and close positions and how I am managing them. And right now, before we get to the trades for next week, let's just take a moment and talk a little bit about trader psychology. All right, this week's post comes from Stephen Goldstein. You can follow Stephen at AlphaMind101. Stephen is a world famous trader. He's a world famous podcaster. He's a world famous trading coach. I was lucky enough to have been interviewed on his podcast 2 times already, and it's a great podcast. So check out AlphaMind101 on Twitter, X, and listen to those podcasts. He interviews hedge fund traders, large institutional traders, retail traders like myself, and it's very good. But whenever Stephen has a post, I always read it because it always contains a lot of value. So let's see what Stephen has to say. The market rewards for you being able to stick to a process, not on a daily basis, but in aggregate over time. So the market rewards you for being able to stick to the process, not just day on any particular day, but you have to do it every day over time. And if you do that, that's when the market rewards you. Make sense? You've got to do it every day. In the short run, it may not work, but in the long run, over time, it works. It will reward you for being able to stick to your process. The market punishes you for allowing your ego to corrupt your process, not every day or week, but over time and at key moments. So what does this mean? It means, sure, you can break your rules every once in a while, right? But over time, if you continue to break the rules, if your ego causes you to corrupt your process over time and at key moments, it is going to punish you. It is going to hurt you. So the takeaway here is, sure, you can break your rules here or there and get away with it, but over time you won't. You can follow your process perfectly. Doesn't mean you're always going to make money, but over time you are much more likely. So the first thing here is you need to get yourself a process. That's number one. Whether you get it from me or you get it from someone else, you've got to get your process that uses good trading principles like, multiple entry signals, good risk to reward ratios, proper position sizing. Okay, this is a process. That's step number one. But step number two, which is more difficult, is following it. But I've traded over 30 years. I know a lot of traders around the world, and the ones that are mechanical have good trading process, stick to it. Over the long run, they make money. The people that are gambling, shooting from the hip, breaking the rules all the time, I rarely see them make money, to be honest with you. So it just decide what camp you want to be in. You want to be in the process driven, good trading principle camp. Yeah, over time, I'm confident you'll make money. You want to be in the gambling mode where you break your rules, your ego gets in the way. If that person were a stock, I'd short it. Over time, I'm sure I'd make money. The person that follows their rules all the time, if that was a person I could invest in, I think that person's stock would be up. So anyway, I hope this was helpful. I hope you can take that in, process that, internalize it. It's important. But thank you, Stephen Goldstein. And again, please follow Stephen at AlphaMind101. All right, let's get back to the potential trades for next week. Now, I have 8 different setups here for next week. Now, theoretically, it is possible that next week all 8 of these could signal and trigger and fire on the same day. All of them. I mean, it is possible. But does that mean that I would take all 8 of these signals? And the answer is no. I only take one signal per day. I don't care if I have 100 signals that qualify. I'm going to have to go through all 100 of those and narrow it down to the best one. And so how do I do that? Well, I give every setup a score, a report card, essentially. If it has one signal, I give it a score of 1. If it has 2 signals, I give it a score of 2, 3, and so forth. All right. So I have to have a process to be able to find out which one I like the best. Now, I could have one that has a really big high signal count, but it has a very bad risk to reward ratio. At that point, I either have to pass on the trade or deduct from that. Okay. I also look at uh, higher time frames. If I'm trading the daily, I may have to look at the weekly time frames to give me some insight on what's going on the weekly. I'll also look at the relative strength of the market. Maybe Tuesday everything's down, but one stock's up. Well, that's going to get an extra bonus point because its relative strength was high. So really, the devil's in the details as far as picking your trades when you have multiple ones. And to me, it's very important. That's how I trade, and that's how I teach my students. I teach them this. And if I could just put in a quick plug for myself, I do teach students all over the world. I've been teaching for almost 10 years now. I love to teach, and I teach a 20-hour one-on-one course, and I teach people from absolute beginners all the way up to the hedge fund, all the way up to hedge fund managers and everywhere in between. But this course is a great course. I mean, I've taught so many people around the world. I've turned out some really, really good traders. I think the best way to learn anything is one-on-one with your teacher or coach or instructor. And the course that I teach is 2 hours a week, and we are together for 10 weeks, 2 hours a week for 10 weeks. That's where you get your 20 hours. And I teach you all the setups, all the strategies I use, all the rules. We do a lot of simulation trading. I throw a lot of curveballs at you to make sure. But to me, honestly, it's very important that when I have a student that graduates my course, that they really know what they are doing. It's really important to me that they become good traders. And so, if you are interested in this course, if you would like me to be your teacher and your coach, I'd love to have you a student. I will teach you everything that I know. And so, if you want to start the process, all you have to do is send me an email. The email is in the link of this YouTube video. And if you do email me, I'll reply and say, hey, great, thanks for saying hello. And I'd like to have kind of an initial get to know you call. I promise you, it's not a sales call. I just want to put a face to the name. I want to learn more about my new student, what their trading goals are, what their challenges are, their trading challenges are. And then it's also a really good time for them to ask me any questions about the format of the course. But again, it's not a sales call. There would never be any pressure. I promise you. I just want to see if, like I said, put a face to the name, find out about the person's trading, and see if we're a good fit. So if that's of interest, please send me an email. Also, if you like online video courses, I have a really good course. I've had it out for years. It's at udemy.com. The link's in the description, but it's a 9.5 hour course on the deep dip buy strategy, which I use very, very often. It's great. It has like 4.85 stars, and it's very affordable. It's between $30 and $50. So again, the one-on-one course, send me an email. The Udemy course for the deep dip buy is in the Udemy course is in the link. So anyway, that's it for my plug. Thank you for allowing me to give you that, and let's get back to potential trades for next week. So first off, Cameco. Cameco is CCJ. We're getting very, very close to a key level. We have an order block from the past, and we have the 200-day moving average. This is the black line. So one of my favorite setups is a rejection of a major moving average that lives inside an order block, and we are getting very, very close. So the 200-day moving average is $100.05 at this moment. We're currently at 104.75. So next week, this could certainly trigger. So I would, at this point, would be looking for a close under or a close over the 200. That would be legit. Either an intraday rejection of the 200, legit, a bounce at the 200, legit as well. And if it does reject that 200 in any form, then a close back below that 200 would be my end of bar stop. Walt Disney. Okay, we have a nice kind of higher order block here. Again, the order block, swing low, swing high, lower, swing low, market structure change defines the order block. Disney has this order block here that we're getting pretty close, but the key level inside this order block is this 50-day moving average. This 50-day moving average is at the moment is 101.32. We're at 103. So certainly we are within striking distance of that next week. So really what I'd be looking for is a rejection of that 50-day moving average. And if it does reject it, then my end of bar stop would be a close back below that 50-day moving average. Gold. All right, gold, interesting here. Similar to CCJ, we have this order block from the past, and right now, the 200-day moving average, the black line has crept into the order block. Those are the levels that I'm looking for. We're not there yet, that's for sure, but we certainly could get there next week. And if we did, that would be a really good high probability trade with a good risk to reward ratio. So next week, if we reject the 200-day moving average and close back above it, I would certainly consider taking that trade. My stop would be a close back under. Additionally, the RSI is at 39.99. There is a chance, just depending when and how fast GLD moves back down, but we could also have an under 30, over 30 RSI signal in the order block before we got to the 200 day. So those are two things that I'm going to be looking for. I'm going to be looking for an under 30, over 30 inside this order block. That would be legit, or a rejection of the 200-day moving average in the order block. That would also be legit. Netflix. All right, so Netflix, we have created a new recent order block. We have a swing low, we have a swing high, we have a lower swing low, we have a market structure change, which defines this new order block. And so here's the order block. We're currently above it. We certainly could come back into it. In this particular case, I have inserted my own key level. That's the green line. I've inserted it at $86. Why did I insert it? Well, look at these three bars. V2, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. It's a V2. Where is the support of the V2? Halfway of the number 2 bar, halfway of the washout bar. Bring that into the future. That's what I'm looking for. I'm looking for a rejection next week of $86. If that rejects it, it would be a legitimate entry for me, and my stop would be a close back under $86. NVIDIA. All right, NVIDIA has a order block here, and inside that order block is the 50-day moving average, the gray line. Now, it's kind of a long ways from there, okay? So I don't know if it's going to get there, but I want to mark it up in advance so that if it does get there, I'm prepared for it. Well, that 50-day moving average, 196.81, lives inside this order block, is fine. The only question is whether it will get there or not. Probably not, but if it does, I want to be ready. So next week, if we reject 196.81 inside that order block, that would be a legitimate entry for me. My stop would be a close back below 196.81 or whatever the 50 is on that particular day. Oil. All right. Well, oil's been all over the place, but we have a new order block here. Swing low, swing high, lower swing low, market structure change. As soon as we market structure change, the lowest closing bar prior to market structure change is this little guy here. Here's the order block. At the bottom of the order block, almost inside it, is the 50-day moving average. As time goes on, this 50 will actually very likely move into the order block, and that's what I'm looking for. So right now, if USO oil were to reject the 50, I would certainly consider taking that. The 50 at the moment is 131.70. If it rejects it, my stop would be a close back under 131.70. Walmart. Well. I didn't think anything ever was going to bring Walmart down, but earnings did it. But look, we are back into a smart money area. We're back into an order block. Swing low, swing high, lower swing low, market structure change. Look how Walmart just took off. And again, when Walmart's up here at 135 and you look back to where the order block was at 119, when this was taking place, was that smart money? Yeah, 100% it was smart money based upon what it did. But look, we're back in the previous smart money area. Doesn't mean it has to be smart money again, but more likely than not, it is. I just need a legitimate entry signal. We are at 34.16 at the moment on the RSI. If Walmart continues down and goes under 30, over 30 inside this order block, that would be a legitimate entry for me. If it rejects the 30 RSI, my end bar stop would be a close back below 30. Alternatively, a rejection at the bottom of the order block would also be legit. That level is 117.80. So I'm either looking for a rejection of 117.80 with a close back below that as my stop, or a rejection of the 30 RSI somewhere inside the order block. Right now we're at 34.16. I have a feeling, depending how long it takes to get down here and how big the moves are, that could happen on the same day where we go under 30, over 30, and reject the bottom of the order block. So it's hard to kind of forecast what's going to happen with the 30 RSI. But ultimately, if we reject the 30 RSI in the order block, I very likely would take the trade. Or if I reject the 117.80, I would take the trade with a stop below the 117.80. And then last but not least is XLU. All right, XLU's had a good few days. Recently, we've created a new order block, and let's look at why. Swing low, swing high, lower swing low, market structure change, lowest closing bar prior to market structure change. I've identified it. Look what lives inside of this 200. I'm sorry, the 200 lives inside the order block. So I am simply, this has had kind of a big move up for 4 or 5 days. I'm not going to try to buy this momentum. I'm going to look to try to buy a pullback, and rejection of that 200 would make a lot of sense. And the 200 right now is 44.41. So I'll just wait. I'll hang out. If it rejects it, I will potentially take it. So those are what I'm looking at for next week, everybody. Listen, I hope you found today's podcast helpful. If you did, again, if you could give a like to the podcast, I would really appreciate that. If I can help you with anything, please let me know. If you have any questions about anything I mentioned here, please let me know. Again, I have a 20-hour one-on-one course. Love to have you as a student. If that's of interest to you, just send me an email. Have the Udemy course, links in the description. It's a great course, but I always like to leave off with, listen, if you have the chance, the opportunity, any day, if you have if you have the opportunity to help somebody out during the day, even with a small little act of kindness, just do it. They're going to appreciate it. You're going to feel good about it. And I think this world really needs more of that. So I have a small little platform, but I at least like to put that message out after every podcast. I'm also a very big animal lover, and animals appreciate acts of kindness just like we do. So, if you have a opportunity during the day where you could help an animal out with their life, please do it. They're going to appreciate it. It's just good karma. It's just good everything. And by the way, I'm happy to say I had my first hit in my baseball season last week. It was a good hit, hard hit single. I ran into RBIs over the past 3 weeks. I've been struggling in my baseball season, but anyway, things turned around in my last game. So very helpful for that. So I need to practice more. So anyway, everyone, thank you very much. I hope you enjoy your long weekend. Again, if I can help you with anything, teaching, consulting, questions, please let me know. Be happy to do it. All right. Have a good rest of your week, and God willing, I will see you next week. Take care, everyone. Have a good weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.